Hi, I'm Greg Corombos. Welcome to Banking Compliance Insights by Wolters Kluwer, a podcast series from Wolters Kluwer. This series was created to deliver insights on compliance trends and strategies for navigating today's regulatory and risk environments. Today's episode, Elder Financial Exploitation, What You Need to Know, will focus on identifying financial exploitation of older adults and the steps banks can, and in some cases are required to take when they believe this exploitation is, has, or is likely to occur. Here to lead our discussion on this subject is Wolters Kluwer Vice President of Banking Compliance Solutions, Samir Agarwal. And he is joined today by Leslie McNally, a consultant with Wolters Kluwer's Compliance Center of Excellence. Samir, let me pass the conversation over to you.
Thank you, Greg. It seems like every day we're hearing about scams. Some where older adults are the targets and taking their money is the intent. We certainly don't want this to happen to anyone or anyone that we personally know. And customers put a great deal of trust in the bank to protect their financial assets. Not only is this going to affect customer happiness and retention, but it also affects how banks comply with laws and regulations as they relate in their specific states. They need to protect their customers. Today, Leslie McNally is joining us. She's been tracking this topic and the laws relating to elder financial exploitation, or E.F.E, very closely. Welcome, Leslie. Tell us a little bit about yourself and the work that you do.
Well, Samir, first, thank you so much for inviting me to talk on this topic. I just feel that there's a lot of information that the more everyone is aware of and has the ability to share with others, the better off we all will be. My position with Wolters Kluwer, I am a consultant under the Regulatory Compliance Analysis Group, and my focus is on monitoring and tracking state legislation as well as federal laws and agency postings. Banking and deposits is the primary focus of the activities that I'm looking at. However, sometimes you'll see some overlap with other areas and lines of business that we address. But pretty much it will bring me back full circle to looking again at state and federal laws and legislation and regulation.
So can you tell us a little more around E.F.E? What is it exactly and what has it become?
Elder Financial Exploitation, or E.F.E, as it's commonly known, doesn't have a set description. However, a description that has been used as identified in the United States Code is typically used. And there they set forth financial exploitation as the fraudulent or otherwise illegal, unauthorized, or improper act or process of an individual, including a caregiver or fiduciary, that uses the resources of an older individual for monetary or personal benefit, profit, or gain, or that otherwise results in depriving that older individual of rightful access to or use of benefits, resources, belongings, or assets. So that gets to be rather a mouthful, but I would say the important thing here is we're looking at finances and assets, financial assets, and the exploitation of older adults. And again, we're running into a description of what is an older adult.
That sure is a lot. Can you give us a quick example of something that most of our listeners would be familiar with in terms of an exploitation of an elder?
Just a very short list of some common examples of E.F.E would be an individual who's in a caretaking or other type of position where they have the confidence of that older American, that they exercise self-dealing. It could be the theft of their property, the theft of their money, check fraud. It could be that they're taking that individual's credit cards or debit cards and conducting illicit transactions.
How come they would not be caught automatically when that would happen?
There's probably a multitude of levels to respond to that. First of all, you could perhaps be looking at individuals who are of an older generation. They're less likely to be aggressive in responding to when they think they're faced with a situation or they find out at the end of the transaction that they've suffered a loss. So they may not report this information at all. It also could be that these individuals know what's going on, but they may be fearful. The individual who's perpetrating this crime may be a person the individual has to be dependent upon to maintain their independence. So again, there I'm talking about caregivers. It also could be that they're suffering just some physical disabilities or health issues that have declined their ability to respond or be aware of what's going on for them. So you have those levels of activities for why there might not be a report. And then it also could be that sometimes you just have situations where the individual's not aware that they've been scammed or had this crime committed against them.
It's really unfortunate. So what classifies or defines an older adult?
A common definition of older adult, and this varies amongst jurisdictions, would be a person 65 years of age or older. There are some states where they start at age 60. There are some states where they'll talk about individuals that might be just older, so to speak, but yet might have some type of disability or inability to be fully representative for themselves.
You've said a couple of attributes of individuals as they kind of grow into an older age. Why are they so attractive as targets? Or I guess wishful thinking is that they're a protected class of individual.
I believe, and reports have shown, that many older adults are targets because they are individuals who have already significant assets. They've worked hard their entire lives, so they've hopefully saved up, or they've perhaps just have a build up in equity for their home. They also might be recipients of recurring sources of income, such as Social Security, pensions, other retirement assets. So they're seen as certain groupings of people who have the assets, have the money that the perpetrators would love to get their hands on.
Leslie, let's talk about also who are the folks that actually take advantage of older adults. Are there different ways that people do that? Maybe even sometimes unsuspectingly they become a perpetrator?
I would say it's very true that there are some folks that are considered perpetrators of E.F.E. that don't necessarily intend to go out and commit a crime, but that they may fall into this category. A common perpetrator would be a family member, unfortunately. And these family members might, first of all, be in a position of caretaking, and they don't have an illicit intent, but they find that perhaps while they're paying someone else's bills, that they think, well, maybe there's one of their own personal bills that should also be paid because they're helping this individual. But sometimes you also have family members who want that piece of the pie and they want it now. The same thing falls into place for individuals who are caregivers. Now, again, they could be family members, but sometimes individuals have professional caregivers, whether this is a person of their own choice or perhaps because of their particular situation, the state or someone else has had to step in and saying, well, I need to be a guardian for this person. And there again, they might have the best of intentions, or they could be someone who's looking to take advantage of the individual. The same can be said of financial advisors. They're looking there at what can they do for this individual who's come to them for advice, but nonetheless, they're looking perhaps at a way that they could benefit themselves by engaging that person in a particular type of transaction or a particular amount of that transaction. The situation also arises commonly with home repair contractors, where they're coming in and they may have the best of intent or they may not have that intent. They may be just looking at taking the money and run, having them sign a contract, get that down payment, and move along.
Is it always a factor of stealing money, or are there other types of exploitations of elder individuals that take place?
Well, certainly financial exploitation touches on the aspect of taking the person's assets. And it can be very easy to think of money as the forerunner because then the individual can do with that pretty much whatever they desire. But it could be that they are taking items from the home. It could be that they're attacking more tangible financial assets, certain types of accounts. They might want to then turn to their own benefit, whether it's putting it in their own name or otherwise becoming the new manager of that asset. So it can be the stuff in addition to the money.
It just reminds me of some bad situations on television shows where, the unsuspecting individual has their business taken from them. So the situation sounds pretty horrible. I'm curious, what's the size or magnitude in our economy of E.F.E victims?
Well, Samir, the way I would answer that question is by looking at what set of the studies have shown that these amounts are. And I will touch on those numbers first, but then I also want to talk about how I believe that these numbers don't fully represent the depth to which these losses occur. There is one recent study that estimates that the financial losses for the E.F.E direct victims, these individuals, exceeds $3 billion. So that's billion with a B every year.
That's just the people that report.
Yes, that's the people who reported, and that's where I feel that these numbers are probably low. And I say that because a large amount of the information for the studies that comes out comes from the suspicious activity reports that have been filed by financial institutions. And these SARs, it depends on what exact information is communicated on a SAR. It can be rather general. It can talk about that they occurred and give a ballpark idea of what the losses are. They might reflect the losses as represented by the individual. It may involve also the losses that the financial institution has suffered from that. And I would certainly put them as likely victims of E.F.E as well. And then you're also looking at information that's been reported to local law authorities. You may have individuals who have just reported that some things occurred, but they don't provide all of the details, so that those numbers aren't reflected in the studies. But it also could be that we have a large amount of information where, whether it's due to embarrassment, they don't want to alienate the caregiver, as I mentioned earlier. Sometimes they feel they still need that person in their life to take care of their day-to-day business. So that information is never reported. And so I think that to say $3 billion every year is at least the amount of how this affects our economy.
Those are some pretty significant figures that you just quoted there. And it gets me a little bit nervous. So how are financial institutions actually involved in this process? How do they get brought into it? I know you mentioned SARS. So what activity are they monitoring?
SARs are reports that they are required to make to FinCEN. They're electronically filed with FinCEN. And that's whenever a bank feels that they're faced with a situation where there's some suspicious activity that needs to be reported. And they have a certain period of time in which to make these reports. And in those time periods, perhaps they do some investigation and then they determine that it's not worthy of a SARS. But in many situations, they are still required to file those. However, what happens with that SARS information is local law authority is not given access rights to that. And so that's where federal agencies have come into play to give the guidance that not only should the SARS be filed by the banks, then what we're looking at is that they should also be sharing that information with local law authorities. One of the things that I would mention is that the reason that banks get brought into this process, in my terminology, it's because they're the right people in the right place at the right time, and it's the right thing to do. So financial institutions have been seen as individuals who can be key players in identifying that it's already occurred, it's likely to occur, or it could occur again. And the reasoning for that is that financial institutions know their customers, they know their members, and perhaps even more so with their older customers and their members, they have more of that opportunity for face-to-face transactions and interactions. So you might have the younger generation, so to speak, that they're doing more activity online. Of the older generation, they might be more inclined to, at least pre-COVID, walking into the bank, having that personal interaction, getting to know who those tellers are, who the other individuals are who assist them in the bank.
Do banks actually hold the right to stop the suspicious activity at the time of, or they just have the right to reverse after the fact?
They do have rights, and there are different federal laws and regulations that come into play with that, but they do have the right to, because of the suspicion of E.F.E, that they can hold a transaction, may not be able to hold it for very long, but they also then have the right to notify local authorities, and perhaps those local authorities will also be able to give them the support that they need to then maintain some of those transaction holds. It also may be that depending on what kind of internal documents and agreements have been signed with the customers in advance, that they may be able to hold on transactions until they've been able to reach an authorized third party for confirmation for the transactions to go through. But those holds can't be there indefinitely. So this is certainly where an institution would need to review the federal laws and regulations to see what their various options may be. They would also want to be looking at their state statutes to determine whether or not there's any additional support they'd have for either stopping the transaction altogether or at least holding it.
So are there any immunities that protect banks?
Yes, there are, Samir. First of all, on a federal level, you do have several agencies that have not only advocated that financial institutions report known or suspected E.F.E activity, but the agencies reinforce, as an example, that there are some privacy provisions in the Graham-Leach-Bliley Act, and these permit financial institutions to report suspected E.F.E as well as respond to requests for personal identification from law enforcement who might be reaching out to them because they might have been aware of the situation before the bank was. And so there are the immunity provisions that are provided for within that act, specifically Section 502. And then also Congress has recently passed the Senior Safe Act. And within that act, and this goes back to 2018, that covered financial institutions and their employees who receive specialized training are also further immune from civil and administrative liability for good faith reporting of suspected exploitation of senior citizens. On a state level, you also have quite a few different statutes that would provide immunity on both a civil and administrative liability for reporting suspected. And again, in all of these situations, it does not need to be held to the standard of someone being able to prove. This is situations that they have that immunity as long as they have that good faith that it either has already occurred, it's likely to occur, or it's likely to occur again.
So Leslie, getting back to our depiction of banks being at the right place, the right time, the right actors for stepping in and helping control the situation. Why is that?
Samir, in addition to the fact that they know their customers or their members, financial institutions are seen as in that unique position where they can spot irregular account transactions or unusual customer behaviors. This is where they can observe or be aware that there's something going on, whether it's that in-person communication, or also there's ways to be looking at online transaction analysis.
I was just going to ask you, how do they do that? What are the types of transactions that they have visibility into?
The transactions that can appear for these types of situations can be seen as what's grouped as erratic, unusual, atypical banking transactions. And some examples of those types of transactions would be an individual all of a sudden starts making frequent large withdrawals. These withdrawals might be increases over what they've done in a prior historical pattern. It could be that they're taking it up to the maximum amounts that they can take out from an ATM every day. It could just be unusual ATM card use. Some individuals don't use them at all, and all of a sudden they start to do that. or perhaps they've never wired money as a transaction before. And now all of a sudden they're coming in, and this is a totally different type of transaction for the person. It also might be that all of a sudden someone who seemed to be perfectly able to take care and managing their deposit accounts, that all of a sudden they're suffering insufficient funds activity, that the bank is having to apply overdraft fees. Perhaps someone is getting that recurring income, whether it's the Social Security deposit or a pension payment, and the bank might observe going, whoa, what happened here? We know that this person is still getting this money, but it's not being automatically transferred.
Something changes, right? And then what is a bank's responsibility around that?
Well, what they will want to do is, first of all, if they've not talked about E.F.E as a topic with their individual customers, this is their opportunity to ask these customers questions and maybe get to learn a little bit more about, well, what's going on? We've noticed that this is a little unusual for you. Is there a particular occasion for which you want to have this money? Is there something that you're looking forward to? I believe that a lot of these types of communications do generate in that face-to-face where you just get to know that teller, you get to know that customer, and while you're standing there and making the internal transaction, that someone's going to say, oh, I'm so excited because I just won a lottery, or I have a birthday coming up for a niece or a nephew. And the niece or the nephew, and depending on the dollar amount, might mean that you can calm those hairs on the back of your neck. You can say, okay, this might be it's an unusual transaction for the person, but it's still reasonable. But when you hear someone tell you that, oh my gosh, I just won this lottery, then you want to ask them more questions. And if the situation isn't coming about face to face in a transaction, and you might have the back office and they're either running analytics or they're just verifying accounts, they're going to notice that that's an opportunity to then reach out and ask those questions. We noticed this. However, if a bank has already talked to an individual about the topic of E.F.E, perhaps ask them whether or not they'd be interested in having an authorized third party in the bank records, so that if something does arise, that the bank has the authority to go to that person. And that would be unless they suspect it's that person who's perpetrating the E.F.E, then it gives the bank the opportunity to reach out to that authorized third party and say, hey, we kind of noticed that this is a little unusual. Can you tell us more about it? Or is this something that you were aware of? And so it's that opportunity to get the information.
You know, the way you describe it, it's almost like they automatically get a PI hat on and are allowed to investigate all the different factors in the situation. Is that really a similarity that I can draw a parallel to, or?
I believe that you can. And of course, there's always privacy considerations. But there again, if you've had that pre-conversation with the customer, there might be some alleviation to there. But earlier you talked about immunity. That again, I believe that if a bank approaches these situations, keeping in mind what type of information needs to remain confidential and certainly privacy restrictions as well, that they can be a little bit more general in their inquiry. But truly, they have the opportunity to put that PI cap on and see if there isn't a way to protect their customer. Again, earlier I've mentioned it's a way for the bank to protect itself as well.
Let's shift a little bit into regulatory bodies and how they perceive the situation. And obviously they're the ones they're approving or giving guidance to these rights. What can you tell us about that? Which agencies are involved, and how does that make a impact into E.F.E and into how we approach those types of situations?
Well, I think what I would do, Samir, is particularly call out FinCEN and the CFPB. And I call them out because for many years, they've been issuing quite on a consistent basis the series of advisories. And the advisories are not only alerting people and raising the awareness of E.F.E, but they're the ones who are giving the feedback to our industry to say, these are some bits of information that we're finding. These are the bits of information we're going to use to give you some suggestions and some guidance. And so although there are the federal laws and regulations, you still want to look from a regulatory perspective as what are these agencies going to be looking for if they are going to be coming in and doing any examinations. So I feel that just knowing that those agencies in particular, and these agencies aren't just acting alone. They're coming out and making joint representations and joint publications. And what they've also begun to do, some of them a little bit more than others, is that they're now issuing these reports not just to the industry, but to Congress as well. And so I feel that that was a great impetus behind the Senior Safe Act. And I think it very well could lead to additional regulation moving forward.
What's Congress doing with that data? They have a governing body within that now says, hey, these are the elderly individuals in our population. At a federal level, these are the rules that we've put in place and they're not being violated? Or how does that get handled?
One of the examples that I would say is that whether it's FinCEN or the CFPB have been sharing information with Congress, they are being meticulous on maintaining the confidentiality of the information that supports their findings. If you look at the individual studies that are generated by these agencies, they get to the point of where they're very even reluctant to talk about who were the individual employees of the agencies who did the work. They would talk about the parameters of the study in a very general sense. They do not provide any information about an individual. They talk about numbers in the aggregate, and they're pretty much there to report information to Congress that says this is the magnitude of the amount of the losses that individuals and entities are suffering because of this. And it's to persuade Congress to take action or other agencies to perhaps get more active if they've not been as active as FinCEN or the CFPB. And they really want to be highly promoting being proactive on this, because not only is this a way for having that PI hat on again to stop it from happening, but it's to keep it from happening to others or keep it from happening again to these same individuals, and anything that can be done to support this.
How do we track this stuff? I mean, just from my time of being a banker, I know we get annual trainings and this is what to look out for or what to see. But the reality is you're dealing with day-to-day transactions. You don't get to see necessarily something systemic all the time. How are banks able to look at things from a systemic standpoint? Like if it's a pension that's automatically going to a caregiver's account on a monthly basis, or any of the other exploitations that you kind of gave an example earlier on. Is there technology involved? Is there specific third-party technology that happens? Or does the bank just employ a massive number of analysts whose sole job is just to look at transactions and to detect?
What the studies have supported and what the agencies are highly recommending is that you definitely do take seriously training your management and your staff to detect things at that one-to-one personal level. But when it does come to going beyond that, especially when the numbers can be so huge, is that they do advocate taking advantage of the technology that may already will exist for that bank. So if they've already got an automated fraud detection system in place, see how they can use that information to help them narrow down what they might need to look at for E.F.E. They might also have anti-money laundering or bank secrecy compliance software. Certainly see if there's a way to do that. And then if you're going to get a little bit more sophisticated and you've either developed on your own or you're working with a particular product for predictive analytics, what you're looking at in that case is if you're starting to see some trends, what might some of those trends tell you that are going to lead you down the path where these trends are highly indicative of E.F.E. having occurred with that. I am aware of one particular institution. They have their own program, but they've said that they analyze hundreds of thousands of transactions every day via their ongoing software and technology products. Out of that, they're finding anywhere from 400 to 4,000 transactions that require a closer look. And so for them, AI isn't replacing that human assessment, but then it's greatly reducing the number of transactions where the humans do still need to get in there and look at things more closely.
That makes a lot of sense to me in terms of many different ways to detect. I guess that my next curiosity becomes, we talked a little bit about tracking, and to what degree does a governing body get involved with tracking? Let's say I have all those tools in place and now I'm able to do it, and I have this list of rules. And I'm sorry if I'm backtracking, Leslie, here to kind of how you were saying Congress gets a copy of the list. What's the action that takes place once you know that this is happening and you try to stop it, or you put some toll gates in place? But how do we administer that even further, or who do we have to corroborate with?
Well, I don't know that I could make a blanket statement about that. I believe that that's something that every financial institution needs to do their own risk assessment to see the degree to which they think that this is an issue for their particular business, as well as, then again, you not only have the federal agencies to consider, but then there's the state agencies and statutes and laws that will prescribe for them what some of those steps might be.
Are the state implications more strict or less strict than the federal governance?
My response to that would be, it depends. I say that because although we might have a very good record of what's going on at a federal level, we've got a real strong history with that. When it comes to state laws, you have an evolution of those state laws, and within that evolution, you can have a lot of descriptions or definitions, I should say, of what is E.F.E, who's an older adult. And it also will then come down to, you can have laws in so many different places. And all of that is further compounded by the fact that these states are changing their laws absolutely every year. One of the things I certainly want to share with the audience is that when you're looking at state statutes, that there is a legislative tracking product that has shared information on an annual basis, and then they'll also provide some summarizations. And the summary of the averages is astounding. On an average, and here I'm just looking at the last 8 years, there have been 32 states on an average that introduce state legislation every single legislative session. And within those states are several states that will introduce multiple bills. And these multiple bills might be in various different statutory chapters. And then of those 32, you have at least 24 of them that are enacting legislation or adopting resolutions every session. The also remarkable thing about those who are passing that legislation is that the list every year also includes states that have passed some type of an E.F.E bill in the prior legislative session.
So there's growing focus on this particular topic at the state level.
Yes. And the other issue that I think is really important to look at, especially within the state level, is that you're going to find that states vary from whether or not a financial institution and or their employees or bank officers are required to report. And in these situations within the state statutes, it's required to report to agencies such as the local adult protective services and or law enforcement. There are also states where they're going to say that you're strongly suggested that you should be reporting, but you're not a required reporter. And then there are some states where they're just blanketly say any person at all. So not even winnowing it down to being a financial institution, that if you have the knowledge or suspicion of E.F.E, then you need to make an official report. Again, it might be to local law enforcement, it could be to the APS on that. So you really need to look at what those laws are We also have the situation where, with this evolution of particularly E.F.E. related statutes, you also have a state's criminal laws that you need to look at. For most states, that was the genesis for addressing the topic of E.F.E., but you might not really think about as a financial institution that you need to be looking at the criminal laws. But if those laws are on the books, then it is something that you need to perhaps add to your selection of what it is that you're currently monitoring.
So it still sounds like every state is different, and depending on that state, the banking rules there, how you're chartered at which level, also are going to play a role in how you need to adhere to E.F.E. There's not a one size fits all.
That's correct.
If someone wanted to find out their own state regs or how to govern E.F.E. in their own jurisdiction, how would they do it?
Well, Samir, we are more than open to having any of our listeners that would like to know more about the state research for their state, where they're located or they do business. We have an email address where they can contact us, and we'll certainly share that information. It's CCOE Program Services Inbox at wolterskluwer.com. And then we just ask that in the subject section you put attention state E.F.E. mandates.
So a lot of good detail here, a lot of good information. I thank you for that. When you are consulting with institutions, is it new every single time?
It would be different to the extent of wanting to make sure that we've covered information for any recent legislative activity. We also like to work with customers that if they've had a change in some of their technology products that they're using, that if there's a way that we can assist them in providing information that would assist them in using those products, then we like to share that information as well. A lot of what we talk about on a federal level might be a little bit more on the maintenance type of coverage, but it depends on the customer. It depends on where they're located. It depends on what their experiences have been. It depends on what their risk analysis has been. We just like to take every one of our customers as an individual situation and see how we might be able to assist them.
Leslie, it was a pleasure to speak with you today, and thank you for sharing so much on this critical topic of elder financial exploitation. I know that you'll be continuing to monitor the activity in this area at both the federal and state levels and keeping us well informed. So, Greg, let me turn it back to you. And Leslie, thank you for joining us again.
That's Wolters Kluwer Vice President of Banking Compliance Solutions, Samir Agarwal, joined by Leslie McNally, a consultant in regulatory compliance analysis at Wolters Kluwer's Compliance Center of Excellence. Wolters Kluwer hosts this podcast and is a market-leading provider of advisory services and technology solutions for optimizing compliance and risk management programs. For more information and additional guidance, please visit wolterskluwer.com or call 1-800-397-2341. Please join us for future podcasts focused on navigating emerging trends in regulatory compliance.